Welcome to Season 4 of the K4 Business Podcast.
Question to the audience. How do you actually know if a passive real estate deal is safe before you put your money in? Our guest will break down how to vet syndication deals with confidence, what red flags to avoid, and the simple steps busy professionals can use to protect their capital while growing long-term wealth. Our guest today is Wayne Courreges III from CREI Partners. He's the managing partner of this firm, where he helps busy professionals build generational wealth through passive investments in commercial real estate syndications. Based in Central Texas, he leads the full investment lifecycle from investor relations as the firm's lead sponsor and general partner, overseeing more than $60 million in assets across Texas, Louisiana, and Alabama. Wayne focuses on acquiring apartment communities and developing RV, boat, and business storage assets in markets with strong fundamentals, all with the clear goal to protect investor capital, deliver high-yield returns, and positively impact local communities. His real estate journey began during his service as a U.S. Marine Corps corporal, and after completing his service in 2007, he spent 16 years with CBRE, and then went into full-time investment leadership at CREI Partners. Wayne, absolute pleasure having you here today. Thank you so much. I know you're on a big road trip yourself. And do you have a favorite quote or saying?
I would say never assume. It only makes an ass out of you and me.
Been there, done that. I've got my own T-shirt that says, hey, tag you're it. So you started your real estate journey while you were in the Marine Corps. How did that spin up from hi, yes, sir, 2 bags full, sir, and how much faster to moving money to property?
It's a good question. So in high school, I actually got my first exposure to real estate. I was dating someone, and her dad was a big real estate developer in the Austin, Texas area. And so I was really fascinated at real estate at an early age, mostly just due to that exposure that I saw with her family. So when I went into the Marine Corps, it was 2003. So Operation Iraqi Freedom was going on and such, but I was stationed in 29 Palms, California. And I was 19 at that time and decided that, if I can try to get a loan and go buy a 2-bed, 1-bath property right outside base and rent it out. And so that's what I did. That was a time where everybody was getting loans. I don't know. It was just, so, I don't know if I put any money down. It's been so long, but yeah, it was like $90,000. 2-bed, 1-bath. So, that's how I started. And, real estate has been in my blood for really since high school.
Is that something that's a family thing? Like, you have a family history in that, or in the entrepreneurial space?
Not so much. I definitely have felt that I've been entrepreneurial my whole life. When I was in high school, I was introduced to the Rotary Club, and I'm a Rotarian now. Rotary Club introduced me to a bunch of other business entrepreneurs, and they had this camp called Camp Enterprise, and you go in and you build a business and pitch the business, and it was all in a one weekend. And after that, it really fueled. I was meeting CEOs and talking to different people, interviewing them, at an early age. So my entrepreneurial spirit alone has been there. Really since high school as well. But then real estate, again, it was just this exposure. And I just love that, these are physical assets that, we can, make an impact to the community. And, I don't have to worry about a tweet or whatever's going on geopolitically in the world because it's all pretty local to, where we're buying.
Partnerships often offer various things, and they sell something and hopefully someone makes money. What did CREI offer that CBRE didn't offer?
It's a great question. So I worked for CBRE for 16 years. They are the mammoth. They're massive. They are the largest commercial real estate company, and it's not a type of company that's franchised. It's CBRE, whether you're in Melbourne, Australia, or Tokyo, or Dallas, Texas. It doesn't matter. The company operates and manages the same, which is great because you have clients out there who own mostly institutional clients. Think of MetLife, JP Morgan, TIAA-CREF. A lot of these institutional groups, they own real estate. But they don't want to manage. They don't want to be in the data. That's not their core business. So they'll hire a CBRE, a Jones Lang LaSalle, one of those large companies that can manage their assets no matter where they are in the world. And they do it the same. So their financial reports that are received the same. They would would maybe have a special point of contact within the company. So so that was, from CBRE, and CBRE touches every aspect: development, property management, accounting services, project manage. I mean, it just every aspect of commercial real estate. So, the clients that I was working for, I was a third party, property manager, and, not owning any of the asset. And so really in 2019, I had finished my MBA about that time. I did a project within my MBA program, CREI Partners. I created the company, the framework of the company during my MBA program. And then in 2019 started this company, because what I realized, and what's crazy is that not many people think that you can own large apartment communities or large buildings. Even if I was in the business, I was thinking these are really reserved for like the institutional type people or companies, like I said, MetLife or JP Morgan's, or very wealthy families. But when I learned about syndications and how we can all pull our money together, and it's really like a team, of really a lot of teamwork to close on these assets. Today, actually, we're closing on a property in San Antonio, and they involved other partners and stuff. So it went from managing assets with CBRE to actually owning assets with CREI Partners, and did both for a few years. I like to say my 9 to 5 paid for my 5 to 9. I have 3 kids, wife, and so it was important that I could support them and do this in a good way. And eventually, I left CBRE not because I didn't enjoy the company; it's a great company, but I couldn't do both. But I had grown my company to a point where it was hard to really focus on both and do a good job. So I, stepped out and went all in on myself.
That sounds like a perfect Cinderella story. The pumpkin. Let's ride the pumpkin into this. Into the...
But I would say that it's not all roses and rainbow. Like any entrepreneurial journey, as you know, it's just, to get to closing today on this property took a lot of stress and calls, figuring it out. I mean, nothing is easy, especially in this market. Cinderella stories happen sort of like that iceberg. You see all the work is happening below the water, and all you see is that tip of the iceberg. But a lot of work and discipline, grit are required in this business.
So when you're bringing things together and you're talking to people, hi, we want to put your money into something, and they're going to be the passive investor. What frame of mind do they have to be in? Because we've talked to different people about, investing money, and some of them do much kind of what you're doing, or they're the brokers for finding the coin, and they deal with folks like yourself. But what do you have to have in the investor's mindset? Like, what do they have to turn on and get understood right quick, so that that they'll be at peace with what was how things are going to unfold?
Yeah, I would say first off, starting with where you are financially. This, even though when I say teamwork, people pulling in their money, it's really for our CREI Partners, we're focused on accredited investors. Accredited investors, this whole business is governed by the Security Exchange Commission in the United States. So the SEC sets guidelines, and for us, accredited investors is who we bring into our deals. So they meet certain income or net worth requirements. I would tell anybody, don't invest your last $50,000 into a real estate syndication. One, it's trapped into that deal until it were to sell or refinance. This is not a liquid investment. It is an investment that definitely provides potential for wealth and tax benefits. And I'll give you an example. There's different buckets of income. Active, portfolio, and passive. The true wealth sits within that passive and portfolio income, not so much the active income. The active income is W-2, and we get a lot of, doctors and, high net worth individuals, executives at, large companies that invest, and they're building because they want to diversify out of Wall Street. I invest in Wall Street. We have our portfolio. However, majority of my portfolio is in real estate, but that's not for everybody. Most people have most of their portfolio into a portfolio of stocks or mutual funds, and then they start diversifying into real estate. They start diversifying into real estate largely because of the tax benefits that happen. So as you get passive income, you can offset that passive income through passive losses, which is what you can get through commercial real estate, through K1 and depreciation. And in the United States, we have bonus depreciation with the most recent tax bill that was passed. So say you invest, $100,000, you will get 100% depreciation. Now, that depreciation's on the improvements of the asset, not the land. You can't depreciate land. So typically you would still see a 70%. But if you get a $70,000 passive write-off on a $100,000 investment, that's pretty good because that offsets other passive income. So that doesn't happen day one because not everybody has that amount of passive income. But over a period of time, say 10 years period, easily, I mean, we have investors making over, 6 figures of passive income, close to 200,000 or more in passive income. And then they get those paper losses in K1s that offset those losses. And then it allows the high net worth executive or doctor, professional to then decide when they want to retire, when they want to slow back. Most of our investors, guys, do not want to get out of their day job. They have a passion for what they do, but they want to diversify and they want to have that option to go off. So that's sort of the mindset is sort of, one, making sure you're a accredited investor, but two, or how do you work to get there? And then two, once you feel like, you're in that different phase on that, financial pyramid that you're ready to okay, I'm ready to go invest into alternative investments. Then these real estate syndications can provide, a great path for continued wealth building.
So, what do you want your clients to ask a sponsor, a property package developer? What do you want them to ask to make sure there's some level of protection they can sleep at night?
Yeah. So there's always risk. Real estate is risky. You have, residents, you have to assume, like if I go buy the property today we're buying, it's 98% occupied. But when we buy that asset, we've done our due diligence. We've done electrical, plumbing, mechanical, roofing. We've walked every single unit. We've done lease audits. We've done, a lot of detailed checked statements, making sure the income's actually coming in. So there's that. But then there is risk where, okay, you're taking this property and they have a relationship with the property manager. And now we're coming in because that property manager is moving on, not because we didn't want to keep them, but they're just moving on. And so we're having to bring in another management staff. And so we have to keep that same type of level of service and, quality of just to keep the residents happy. So there's always risk. COVID happened, things that are out of our control, interest rate hikes, insurance, taxes, property taxes. I mean, there's all these different things, but that's in any investment. If there was one investment that had a 100% surety, then there would be no other investments because everybody would just go in on that one investment. So, but what I would say to really drive into your question, this is a great one, is when you're looking at evaluating real estate syndications, think of it like no more complicated than buying a business. Your business has income, has expenses, net operating income. After net operating income is debt service and maybe capital expenditures. And so if you think of it as just a business, you're buying, multifamily 1236 Main Street, that is just a business, and your residents are your customers, and they're bringing in, they're paying the rent, the income, miscellaneous other, maybe the reimbursed utilities. Then you have your expenses, utilities, payroll, repairs and maintenance, et cetera. So just that framework of just not overcomplicating the real estate when you're evaluating a deal is just a business. And that business has income, expenses. And so that's the start. The second is that for every investment, there's a jockey on the horse. And you want to know who that jockey is. I'm the jockey on the horse for all of our investments for CREI Partners. We are lead sponsors. We find the deal, put them under contract, take all the risk up front, close the deal, then we operate it, and then we manage that whole process. And it's not just Wayne. Like I have 3 other team members that work alongside me for our investors. But you want to know the person, and you want to know that person because over the 5 years, you want to be able to ask questions. And I say 5 years, that's the typical hold period. You want to ask questions. You want to see that they're sending monthly financial updates. Do they have an investor portal? What's the transparency like? Have they gone through any downfalls with any other properties? How did they come back? How do they communicate? So just seeing that they're a good person, like, is this somebody that I want to do business with? It sounds pretty lame, like it's just an easy answer, but you're investing more so with the person than the property. Over time, as a passive investor, you do sit back and you do learn what to look out for on the next deal, or like, hey, this person is being transparent, they're following through what they're saying they're doing, or if they're not, they're at least providing communication on what they're going to be doing to fix it. I think is important.
What should we be cautious of? What are the flags to say stop so that the person's protected?
So In the United States, we have, like I mentioned, it's governed by the Security Exchange Commission. The SEC have different regulations, but a 506C offering is really the world we live in. And Canadian investors can invest with us in the United States. But that 506C, in doing so, we have to have a private placement memorandum. And then that private placement memorandum, it goes over the risk, it goes over the investments. And not every deal is going to have the same risk or the same business plan, right? So through that private placement memorandum, then there's a subscription agreement and a company. Typically, you're not going to be able to make any changes to those agreements, but having an attorney review or you reviewing and just making sure you're comfortable with those documents is step one. If you don't have a company agreement in place, because remember, it's like buying a business, there's a limited partnership or a limited liability company that owns this asset. And within that asset, who's the managers and who's the members, limited partners, general partners. I mean, from a step one, it just make sure you have the paperwork. And even if the presentation is like, oh, we're going to 2.5x your investment, the presentation is marketing material. What really matters is what's in that private placement memorandum, what's in that subscription document and the company agreement. So that would be something is, spend time, talk to them. Also, if you're investing in real estate, having that real estate attorney is wise, but also getting your tax person. And this is not H&R Block. Like if you're starting in real estate syndications or passive investments, you have a portfolio or a net worth of a certain point. Now it's time to have, if you don't already, like bring on a tax strategist and, tax professional. And those are two separate things. The strategist is not always the person who enters the numbers and submits for taxes, but bringing them on board and having given them the opportunity to look at the deal and ask questions. So those are those things. I would say once you become a passive investor, all that hard work, I mentioned the iceberg analogy earlier, all that hard work is done before you sign and wire funds. So networking, making sure you find a good fit, jockey on the horse that you trust, reviewing the paperwork, the legal documents that actually matter, not the marketing material, that you have, other people look at the deal, maybe your accountant, your tax strategist, or, your attorney. At that point, once you sign and wire funds, there's really nothing more you can do because you are a limited partner, you are passive. And that's where, all that hard work of due diligence you did prior is important. It's a lot. And, we have, and, it's a free program. It's informational. I'm huge on education. That's why we do this podcast. But passiveinvestorcoaching.com, it has like 5 hours of just content what we've created. No sales pitch or anything on it. It's just, how to evaluate a deal, how to, vet sponsors, et cetera. So there's a lot to it. But remember, all the hard work is done prior to signing and doing paperwork. Because once that's done, you are, invested in a deal, good or bad.
I got a thought here. Like you've just talked about a person coming up and saying, listen, I got a bag full of cash. I got enough wealth around me, so enough padding. So if things go sideways, it's not going to take my knees out. And I get that part. Having an accountant handy and having a tax accountant handy, two different animals. Having a real estate lawyer, again, different than a typical lawyer. Do you then, the investor, have to be a company coming in? Is that a better fit, or can you come in as Joe Blow? Here I am. These are the guys that I've hired to make sure I'm in the right direction. Vet the paperwork. Is it better to be a company, or is it better to be a private person? Is there an advantage on either end?
There's not an advantage either way. Just who you want to have the passive losses and the passive income go to. And the reason is because every property that is purchased, I can only speak for myself because maybe somebody out there is buying it under their name, right? But for us, every commercial real estate property we buy that we syndicate is owned actually by a limited partnership. There's a managing entity that's a limited liability company, and then there's a limited partnership which actually holds deed title on the property. Partnership, the limited partnership, consists of limited partners and general partners. General partners being the managers of the entity, limited partners being members of the entity. So say if someone were to get sued, or, a resident or a tenant, an office tenant, somebody sues the property, the shield hits at that limited liability company and that limited partnership. So if you're signing as an individual, you already are part of a company by signing that company agreement. Now, I do see people as with their company, because they want their company to get that passive income and then get those passive losses. So that's where that tax strategist and your accountant come into play. But as far as a legal standpoint, this has been something that I've spoken to our attorneys in depth about, because we get asked this quite a bit. When they join our investment, they're signing the company agreement, so they are shielded from any liability. So the only liability for investors in our particular deals is the investment they put into it. So if you put in $100,000, that is the risk of the deal. That's the benefit of staying passive, because if you do get more on the active side, there's more exposure for me as an active investor. And that's okay. That's the world I live in. This is what I do for a living. Just like if you're a doctor, there's risk in that, right? That paperwork doesn't matter if you sign as a company or an individual, because you're backed by the company owning the asset.
So if you buy, let's say I get involved in a project, I drop $500,000 or 100,000, whatever the dollar value is. And do you make your money then over the time period to leverage it? Do you make your money on exit? My next question is, if I'm going to build it as a pyramid, not as a pyramid scheme that sounds like I'm hoodwinking people. But if I'm looking to build that, do I wait halfway through, leverage what I got on the go with you, and then buy another asset on a different project and just keep leapfrogging it like that? Is that kind of the overall strategy? If you're looking to grow?
Well, there's different strategies here. I love talking about this stuff. So it's like you have to determine if you're a cash investor or an equity investor, and there's different types. Just think like when you buy a stock, there's value stocks and there's growth stocks. There's different risk, and as you age and you get closer to retirement, your portfolio and your risk tolerance should shift, right? Because you don't want to be so tied into risky investments or risky stocks. So if just relating it to what most people understand and know about is the stock market. On the real estate side, it's a similar thing. You have your riskier projects, which are development, taking raw land, developing, leasing up for a speculation. It's more of a speculation play, but you can make a hell of a lot of money that way and great returns. But depending on where you are in your investment life cycle, or as you're getting closer to retirement, and your allocation to those type investments are going to change versus a cash flow investor who is buying maybe an 80s, 90s, 2000 property that already is 90% leased, already has strong cash flow, already has a property manager. It's a different risk profile. So within real estate, you look at risk profiles. Then you got to get comfortable with the asset class that you're investing in. Are you comfortable with office and retail? Are you comfortable with multifamily, storage? What we've done as a company, and this is not sales pitch on CREI Partners. It's a comfort of whoever as you're looking at deals. But for us at CREI Partners, I've built the business around 80% multifamily, and I've done 80% multifamily because at the end of the day, everybody needs a place to live in the industry long enough to know that like cycles go downhill, offices shut down, people start working from home. It's easier to stop paying office rent than it is your place that you live in, right? Everyone needs shelter. It's a basic, need of life. And so we've gone all in on that on day one cash flowing deals. I've previously had an investment that was considered a deep value add that didn't, expect to have cash flow for 2 years. And I hated that project because that project, there's a dopamine hit every quarter when we send distributions. So we've shifted 80% multifamily, full focus on multifamily with quarterly distributions. They have to cash flow day one. This property we're buying today that we're closing on, January, we'll send our first distribution. 20% of the rest of our portfolio is more of that speculative. We're developing a 150-unit multifamily. We're developing a Marriott hotel. We're developing an office retail. I've developed storage. We've done build-to-rent communities. We can talk about build-to-rent communities if we want. Those are going to be more speculative. But for me, my risk comfort is 20% development, speculative type deals, 80% day one cash flow. Every investor needs to determine if you're a cash flow investor or an equity investor. Equity investor is you don't need the cash flow now, but you really want that upside. So that 100,000 today could be 250,000 year 3, year 5, year 7, whatever the time frame is on that business plan, or that cash flow, which is going to be less risky, maybe lower returns, but higher preservation of cash and, consistent income and those tax benefits. That's where that bucket sits. Or you can do a little blended of both, which we have plenty of investors doing with us on each of the deals.
You got cut your teeth in apartments, that first self-storage, was there a part of you that said, oh, this just isn't sexy enough? And I'm guessing you got over it, but if you did get over it, why?
Yeah, great question. So I don't like self-storage, mini self-storage. I think it's easy to build. Most cities have plenty of zoning for storage. It's pretty low cost, easy to get in, low barrier to entry, think from an economic standpoint. Where I, stuck my teeth in was like large storage, not the mini storage, but these are all 20 by 50,000 square feet with a 14-foot roll-up door, a walk-in door, have a 30 amp or a 50 amp power, depending on the unit, in the very back of the unit. Think about RVs. I'm in an RV right now, as traveling the country. And, this unit, I don't want it in my barn or outside in the elements. I want it stored in a nice enclosed facility that has insulation, that has power, and, that's covered, fully enclosed. And so that may not be the case for my travel trailer that I own that's in my barn, but this one, it's enough money where I want to protect it. So it's a different type of clientele and a different need. The other thing is there's a lot of businesses that don't necessarily need a front office, but they need a place to store their inventory. So think HVAC, mechanical, any type of mechanical, electrical, plumbing, disaster recovery, generators, etc. So we have a lot of customers that just need that 1,000 square feet to store their business. And those are the best customers, in my opinion, because now our unit is now part of their business. It's a tax write-off. It's become part of their their need within the business. So that's where I got really excited on is that type of storage. And we own 2 of those assets. One's in lease up mode. We've been open a year and we're 67% leased. That's incredible for 1 year of opening in the self-storage business. To self-storage, that could take 3 to 4 years. My other location, we're 100% leased. We have a wait list. We have bumped rents. When we first bought it was about $375, is now going to about $625 a month, $625 a month. So we've pushed rents while staying at high occupancy. So yeah, that's what I like. But that still stays in that 20% bucket for me. 80% is still going to be that multifamily core business, whereas this RV boat. But I'm not a big fan of just mini self-storage. A lot of investors do extremely well at it. I'm not attacking the business. I just want to be in something that has a little harder a barrier to get into.
So when you're looking at the markets in Texas, Louisiana, and Alabama, what are you looking for? Like, what tells you that's the ticket, that's the place to go? That one, not so much so. Swampland in Florida is kind of, someone will talk about, I can sell you some land, it's just all swamp, or the Brooklyn Bridge. Pick whichever country, what part of the country you want to go into, right? But what triggers that's a great idea or great spot to put park money into and build, either green build, brown build, whatever?
Yeah, so let's talk through macro states. So red states, Republican, Democrat, not to get political, but it is what it is. Being in a more conservative, landlord-friendly state is investor-friendly. So Texas, Alabama, Louisiana, Florida, Georgia, South Carolina, you're going to, the Southeast and West, you're going to have more landlord-friendly. A lot of migration coming down from north coming to the South. You have a lot of people from the West coming into the South. So real estate, it's supply and demand. So about the migration and the jobs. Texas, where we live, where I've grown up, I mean, the amount of jobs that we are doing, and it's because we're a pro-business state, and heavily encourage and incentivize growth in business, not penalize through taxes and, getting into, the intricacies of the actual business, like letting business owners do what they do, and that's grow and have a for-profit mindset. So that's sort of from a macro, those states is why I like them. Now, when you start getting into the cities, there's different cities. Like in Texas, I grew up in Austin. I love Austin. It's a town. My parents live there. I will never buy Austin, Texas. Austin, Texas is extremely blue. We're talking about red and blue, like it is blue as can be. Father and my mom, they tried to, install a whole house generator on their home. It took 8 months to get a whole house generator because of all the different agencies that had to go inspect and follow through. My, home generator, and this is just an example, took a day. It all happened in 1 day, 8 months, 1 day. It's crazy. But if I look at Dallas, I look at Houston, look at San Antonio, I look at the outskirts of Austin, Texas, Georgetown, San Marcos, Buda, Taylor, those are incredible, fast growing markets. And so you have to know, like in Alabama, we're really targeting at Huntsville, Alabama. And we love Huntsville, Alabama because of all the growth, especially with military, technology, et cetera. But we have a partner that I trust incredibly. We've done multiple deals together, but he lives near Huntsville, Alabama. So that's really important. Louisiana, there's a lot of growth. Oil and gas, as oil and gas and the medical and such grow, parts of Louisiana. So we bought into Lafayette. So every market, we start off with the state, then we go into the cities, and then we have to, go into the neighborhoods. You can't change. I can go in and buy an asset and spend, $1 million renovating, but if the rest of the properties around it isn't. So even within the cities, now we're starting to get much more, in depth into the markets, different submarkets. So you're not going to know that unless you're in this full time. And I would say, majority of the stuff that we have in multifamily is in Houston and San Antonio at this point. Even though we have assets in Louisiana and Alabama, the bulk of our portfolio is in the Texas Triangle.
One of the things I noticed here in Ottawa, every once in a while you see an area that, as you describe it, it's not optimal, right? You wouldn't leave your car keys on the dash because nowadays you don't do that, but it just you lock everything up. There's a process called gentrification. Are you also involved in that universe too? Because you're literally taking something that's not optimal and making it optimal, and it's influencing the change in the neighborhood. I've seen that happen here in the city of Ottawa, where you see there's a facelift happening, right? It's not instant, but is that part of the box you play in?
So for me, no, there's opportunities and there's huge tax benefits. I'm not looking for our investments and investors. I'm not looking for home runs. I'm not looking to, 10x, 5x, 3x, anybody's capital. If I can get a 1.8 to 2x multiple on investments or maybe a little higher, we're doing great. We're getting 2-3 base hits and we're going to win the game long term. I think once we start getting into opportunity zones, there are definitely people with appetite there, and we need those people. We need those areas to, provide, better housing and better, that needs to happen. But for me personally, I'd rather stay in the world of preservation of cash and having strong day one cash flow. I'm buying a business. I want that day one cash flow now. And we will still, do renovations. We'll do those things at the property, but it's not needed. The property we're buying today, I don't need to put any CapEx into it, anytime soon, and the roofs are in great shape. It's painted, the pool's been resurfaced, like all those things. So when January, I do that first distribution, that's cash flow from the business, not me having to force capital into a deal to then potentially get residents to pay a little bit more or to get them leased up. So my preference is just to buy day one cash flowing deals at a great price and implement a value add component. But I don't like personally the risk of going into, because then you still have the risk if you go in and go into an opportunity zone that other buildings and areas are going to improve. And then you have to change the whole perception of the area. That takes years. And it just, for me, it's not in my comfort zone. However, it's needed. And I think people do really well at it. It's just not my appetite.
I understand being patient with your capital, but let's say your needs substantially change. Is there an exit strategy over a period of some time where you can get out even with penalties, or you're in till it sells?
Yeah, it's a great question. And it all goes back to that company agreement and that subscription agreement. So every deal will have, every sponsor will have different stance on it. Maybe they allow that person to sell their shares to another person, another company. Maybe there's that. At CREI Partners, we do not allow that. Like it's, you've invested into a deal being used to maybe pay for the payment of the property or implement the business plan strategy. If there's a one-off, like, something crazy, then yeah, we're human. We will see what we can do. But by the paperwork, that's not an option. So, but every group is going to be a little different. That paperwork, that's where it just really matters. Even if someone says, yeah, you can do it. What, like at the end of the day, like what is the legal, four corners of a page say you can do? So that's what I would say. Just look at the documents, see if it's, and if that's important to you, then maybe, real estate syndications aren't the correct investment. Maybe it's more of a REIT where it's, it's like kind of you're not owner of the asset. You don't get the tax benefits, but there are real estate investment trusts that you can buy into, and it's more like owning shares, like stock. So, that would be my thoughts on that. Things happen, one-offs may occur, but for CREI Partners, it's, once you've invested, you're a partner on the deal till we refinance or sell.
Generational wealth. I've heard people talk about this. In other words, it's one thing, I'm going to invest money now. I'm going to realize my gains between any short term or long term, like 5 or 10, maybe 15 years out. But some people, they amass a fortune, and people speak of old money, right? And basically, it's been sitting there in different forms, and there have been folks that have come along, and probably in the real estate industry. Is that something that you can help a person establish? Here's your foothold, and is that like, although you have a 10-year map out to you either looking to exit out yourself or go for the next 10, right? If everything goes really well, is generational wealth a component then that you would tie into this, and how would you do that?
Yeah, we have a lot of investors who they are putting investments in their kids' names or their family trust. It's they don't need the cash flow now, but they're building it up for their future, generations. That, there's a saying, out there, 90% of the, millionaire get the real estate, but now, millionaire is not the golden standard anymore. I think most people can be millionaires in their lifetime if they just invested in the stock market. But if you start getting into real estate, you're looking at it different from the depreciation, the tax standpoint, that cash flow that we're talking about, and just the diversification. So in talking with any large, investor that is looking to diversify, just understanding, where their current investments are and what they're looking to get out of from a real estate. And it goes back to that cash flow or the equity. If they're a cash flow investor, we will find them more conservative type deals like the property we're buying today. That's a day one cash flow built in 1981, solid building in a great location. Where if they're looking to like have some of their allocation towards development, we're building that multifamily. And one of those investors is doing $4.5 million into that development. And they're not getting cash flow on that until it's built. But that is a huge strategy, and it's going to do extremely well for them, once we lease up and, sell the asset. So absolutely, definitely would love, more of those type conversations. I also want to make sure that just like as any investment does have risk, and me as the jockey will do everything I can my fiduciary and my work ethic and my grit is to protect capital and to do what we say we're going to do. And if I feel like that investor and I can connect, see eye to eye, have similar values, then there's definitely opportunities for growth and have that generational wealth down the road. The biggest thing on generational wealth has, a huge part of that is tax strategy. And so I have investors, and I'm happy to put anybody who listens to this call or this podcast to want to talk to those people. They pay zero in taxes, and they get 6-figure in income, those depreciation, those losses. Now there are catch-up taxes, there are other ways, and then we can talk about that generational wealth through 1031 exchanges, sell the asset, pull that into another investment. There's different vehicles for that. Or to your point, just continue doing syndications and then really just wait till you die. And then your family, pay taxes on, the rate at that time. They're not paying the accrued taxes over the years. There's different ways to look at it and have great income and generational wealth, through real estate, but taxes and that has to be part of the conversation with any investor.
What is risk impact? I hear these terms bandied about. What is risk impact? What's it mean?
Risk impact. I don't know. Can you tell me more about it?
Well, so there's a risk impact. So if something goes sideways, right? What's the fallout to you? And then there's also the risk probability. So it's and I guess the question is, how do you balance that out? Like either yourself or you're talking to somebody. What's that fine line, right? Like you said earlier, if everything's 100% guaranteed, that's the one everybody's going to go to, right? But that ain't so. How do you? Is it like 20% risk, 80% yield?
Yeah, and you can have a great investment like the deal that we're buying today. Going back, it's a great investment, cash flows. But if we suck at what we do, it's going to be a horrible investment. So you got to know that the person who's running the show, the team, what's their experience, and what's their day-to-day plan to execute on the deal. So I would say from a risk standpoint, going back to, whatever your initial investment is, that is the risk for the passive investor. So that's what you have to be willing, to lose if you invest in this type of alternative investment. And, people invest in oil and gas and, crypto, and maybe buying into your brother-in-law's business. I mean, there's different investments and different risk. This definitely sits in that alternative investment. But I would say real estate as a whole, and this is just my opinion, but having been in this industry almost 18 years, it's a brick and mortar business. The business itself, unless there's a massive flood or hurricane, earthquake, and even then it's insured, so it's going to be rebuilt. The physical asset risk is less than, say, what I would say like a paper investment with stocks, where something or someone or some other company, something can happen to disrupt the market. Look at NVIDIA, those stocks were going crazy, and then they came out with their own version, and then the stock just drastically dropped and impacted, every, fund out there, because, all these, fund managers had NVIDIA in their portfolio, and they still do, obviously. You don't get that with real estate, Yeah, it may not be as sexy with 20, 30% annual returns year one, but if I can give you 4 to 7% cash flow year over year, and then in year 5 sell and make a profit, 5% average annual return through the hold period, in a much more stable, don't have to worry about what's going on in social media, or who the president of the United States is, or what's going on overseas, or, what happens anywhere, other than what's happening within that 1 mile radius of that asset. So there's different risk profile, risk impact on that as well that I think is important.
Wayne, a lot of our listeners from the States heard Canadians can also invest with you. How do we reach you if we want to learn more?
Yeah, no, I appreciate the opportunity. So CREIPartners.com is our website. You can reach out to me directly at Wayne@CREIPartners.com. But I would heavily, if you're listening to this podcast, you're wanting the education, go to PassiveInvestorCoaching.com. There's no sales pitch. It's free. It just provides an incredible amount of content all at once, or, pause and play as you choose, to learn about real estate syndications. Again, it's PassiveInvestorCoaching.com. But if you want to reach out to me directly, Wayne@CREIPartners.com is the best way.
Wayne, I want to say thank you so much for being our guest today. It's enlightening. It's good to understand this. I have a colleague of mine who's into the commercial real estate and the syndication here in Ontario. So I got to know what you've been talking about. Totally understand it. To my co-host, Wayne Pratt, thank you. And you, the Knack for Business listeners, because we really appreciate your time. So if you are looking to invest in the U.S. into residential or other property, reach out to Wayne. He can help you start getting into it. He's got a free course that can give you a little more enlightenment before you dive into it. And, as you can hear him, he talks about having success and the jockey that matters. So let him ride your horse, for lack of better words. If you find the horse, though, I don't know.
Everything you heard today is for educational purposes only. It's not professional advice. Before you act on anything, talk to a certified expert in your area. Your accountant, your lawyer, someone who knows your situation. We share perspectives. You make the decisions. Want more? Head over to blog.knack4business.com, packed with practical episodes on AI, marketing, leadership, and growth. No fluff, just the good stuff. Subscribe while you're there. Until next time, keep building.